current era, the interest rates are changing fast. The discount rate calculated will equate the present value of the cash inflow with the present value of cash outflow. Now, these are the few capital budgeting practices in India. Capital budgeting decisions are undertaken at the top management level and are planned in advance. The corporate follow mostly top-down approach in this regard. Discounted cash flow techniques are more popular now. High growth firms use IRR more frequently, whereas payback period is more widely used by small firms because it is very simple. Less technique is used. PI technique is used more by public sector unit than by private sector unit. Capital budgeting decisions are of paramount importance as they affect the profitability of a firm, because ultimately in long run the investment made will be absorbing cost, and therefore the project is required to be looked at minutely and are the major determinant of its efficiency and competing power. Okay. Question from Kapil is, what is profitability index technique? So this measure total present value of all cash inflow, that is 1040 rupees, and total present value of the cash outflow 1000 rupees. So NPV, this is the form of NPV only. NPV is an absolute amount. Here 40 rupees is net present value. 1040 minus 1000. Here it is 1.04. So they are related. Even profitability index may also ignore the interest rate. In that case, as I have mentioned, 1200 divided by 1000, 1.2. So this has taken care of NPV. This has taken care of the constant value of money. Now, the important component of working capital management is concerned with the problem that arise in managing the current asset and current liability. Question from Praveen. What is the benefit of moving some amount in capital budget than revenue? That depends upon the policy of the organization. Ultimately, if you look at the balance sheet, there are two kinds of fund. These are the long-term fund. These are the short-term fund. So from long-term fund, generally capital asset are produced or fixed asset, and from short-term the current assets are produced. So it is risky. If you use short-term fund in capital form, it is risky. Therefore, it is generally not preferred. But vice versa is good. Some of the long term can be used for the current asset. So depending upon the management's own policy or aggressiveness, the long term fund may be used for current asset, but it is not wise to use short term fund for the capital feature. So working capital management, as the name suggests, is focusing on two items, current asset and current liability. Goal is to manage the firm's current asset and liability in such a way that a satisfactory level of working capital is maintained, because working capital ultimately is for two purposes. One is smooth functioning, and second one, we have to reduce the cost of making investment in the working capital. So we have to optimize. If there is a shortage of working capital, your smooth functioning may be in danger. If there is a higher working capital, then the cost of carrying working capital will be higher. There are two concepts. One is the gross working capital, the current asset which represents the proportion of investment that circulate from one firm to another in the ordinary conduct of business, and net working capital is the portion of current asset financed with the long-term funds or current asset minus current liability. The net working, yes, question from Kapil, what is the ideal working capital? So there is nothing like ideal working capital. It depends upon which business you are in. So if you are in cement or tiles or milk industries, the working capital requirement may be different. Sometimes it is possible that in purchase you get the credit, but in sale you cannot avail, you cannot get the, you need not to give the credit, and vice versa. Working capital is not a ratio. Working capital is an absolute amount. Current asset minus current liability. This is working capital. So it is not a ratio. Current ratio is CA by CL. That should be generally 2. So for working capital, we cannot say what is this is the absolute amount. This is the absolute amount. So there is nothing like ratio, which is ideal. So depending upon the business circumstances, your reputation, your aggressiveness, the market condition, that will determine how much working capital you require. Determining financing mix. Financing mix is the choice of sources of financing of current asset. So from where the current asset will be raised, short term and long term. These are the short term: trade credit. There is implied cost. There is no explicit cost. Bill discounting. There is explicit cost. Intercorporate deposit. Public deposit. Commercial paper. Factoring. Factoring is like bill discounting. Public deposit and commercial paper only apply to the limited companies. Now these are the few approaches: hedging approach, conservative approach, and trade-off between the above mentioned two approaches. Hedging approach is the process of matching maturity of debt with the maturity of financial needs. It is conservative. According to hedging approach, the permanent portion of funds required should be financed with long-term funds, and the seasonal portion with the short-term fund. Under this approach, working capital is equal to 0 since current assets are not financed by long-term funds. Conservatism approach, on the opposite, is strategy by which the firm finances all funds requirement with the long-term funds and uses short-term fund for emergencies or unexpected cash flow. Okay. So request from Abhinav, explain hedging again. This is the process of matching maturity of debt with the maturity of financial needs. According to hedging approach, the permanent portion of fund should be financed with long-term funds and the seasonal fund, a seasonal portion with the. So if you look at the working capital graph, it fluctuates, So this is time, this is working capital. It generally fluctuates like this. So this is financed by long-term fund. This seasonal demand is